In today's video, I'm going to teach you how to enter loan in QuickBooks. We'll walk through setting up the loan account, recording the money you received, and entering ongoing payments so your principal and interest are tracked correctly. First, create the liability account that will hold the loan balance. Open the settings gear icon, choose Chart of Accounts, and click New. For account type, select long-term liabilities if the loan will last more than a year, or choose other current liabilities if it's a short-term loan. For detail type, pick Notes Payable. Give the account a clear name, such as Bank Loan, Main Bank, so it's easy to recognize later. Then save and close. This step builds the place in your books where the amount you owe will live, making your balance sheet accurate from day one. Next, record the cash you receive from the lender. Click plus New and select Journal Entry. Date it the day the funds hit your bank. On the first line, debit your bank account for the amount received. On the second line, credit the loan liability account you just created for the same amount. Add a helpful memo, like the loan agreement reference or purpose, and save and close. This increases your cash while recording the debt, keeping assets and liabilities in balance. If you use bank feeds, plan to match the deposit to this journal entry so you don't double count the money. Finally, record each payment with the correct split between principal and interest. Click plus New and choose Expense. Select the payment account you used and set the payee to your lender for clear records. In the Category Details area, use line 1 for the loan liability account and enter the principal portion of the payment. Use line 2 for interest expense and enter the interest portion. Enter the total payment amount to match your bank. Include a memo such as the payment period, then save and close. Only the interest is an expense that affects your profit and loss. The principal reduces the loan balance on your balance sheet. Use your lender's statement or amortization schedule to determine the split each month. If the amounts are consistent, consider creating a recurring transaction later so you don't have to re-enter the details every time. That's it. You set up the loan account, recorded the funding correctly, and entered payments with a clean split between principal and interest. Follow these steps and your reports will show the remaining balance on the loan and the true cost of borrowing over time.